So it looks like the price of silver tanked today, down over 8.5%. And the reason for that is the CME, or the Chicago Mercantile Exchange. They raised the margin requirements on all precious metals for the March 2026 futures contracts. And that included silver, which forced many investors to either come up with more collateral or sell their position. And as a result, we saw a massive sell-off. Now, why did the CME raise the margin requirements? Well, officially, to protect the system. They want to make sure anyone who was trading on margin, aka credit, had enough collateral or cash to cover their position. Otherwise, they'd have to sell. Now, unofficially, that's a different story, and there are plenty of skeptics who have their own beliefs as to how and why they did what they did, and I'll save that for another video. Well, there were two other times in recent history where we saw something like this with silver. That was in 1980 and in 2011. So in 1980, there were three brothers from Texas. They were the Hunt brothers. They were billionaires, and they bought up 100 million ounces of physical silver. That was roughly 70% of the global market at the time. This pushed the price of silver from $6 an ounce in 1979 to $50 an ounce in January 1980. 800% year-over-year increase. However, the way they were doing it was massive leverage. When the Chicago Mercantile Exchange finally saw this, they introduced something called the Silver Rule 7, which dramatically increased the margin requirement for purchasing commodities like silver. Of course, the Hunt brothers couldn't meet these requirements, and on March 27th, 1980, they defaulted on $100 million worth of obligation, infamously known as Silver Thursday. The price of silver went from $50 to $10.80. The brothers lost $1.7 billion. In 2011, the Fed was printing money through what is known as quantitative easing. This was their way of stimulating the economy after the 2008 financial crisis. People were able to access money pretty easily. Investors started getting worried about rising inflation because of all the money that was being printed. So a lot of the money went into precious metals as a hedge. The price of silver spiked dramatically. And since it was so easy to borrow money, traders were trading on leverage. And eventually, the Chicago Mercantile Exchange saw this and raised the margin requirements. Investors had to either liquidate their position or come up with more cash. The key differences from those two incidents and what happened today, those rallies were speculative, meaning it was mostly hype. However, in 2025 and beyond, the way I see it, there's a different kind of demand that wasn't there in 1980 or in 2011, and it's very real. And one other major thing to note, China owns 60 to 70% of the world's refining capacity when it comes to silver. And on January 1st, they are getting ready to implement major export restrictions when it comes to precious metals, aka silver. Not to mention where we stand right now with the Fed, a lot of people are still expecting it to lower interest rates at least once to twice in 2026.